You think you're in control of your life? Think again. From your rent to your job to your dreams, one invisible force controls it all: interest rates. And today we'll show you how this quiet number secretly rules your world. But before we dive into the rabbit hole, let me ask you a simple question. How much do you know about interest rates? Let me guess, you heard of them when buying a house or a car, right? But here's the catch. Interest rates are way more than just those numbers on your loan documents. They're like the puppet master of the economy, pulling strings that affect your wallet, your career, and even your daily cup of coffee. So here's the deal. In part 1, we'll break down what interest rates really are and how they work. Part 2, we'll explore how these rates shape our economy and our lives. Part 3, we'll expose the hidden game and reveal who really benefits from interest rates. And finally, in Part 4, we'll equip you with the knowledge to outsmart the system. So buckle up, because we're about to take a wild ride through the world of finance. Now let's start by addressing the elephant in the room. What the hell are interest rates? Don't worry, it's not as complicated as it sounds. Imagine you lend your friend $100 because they needed it for a rainy day. You trust them, so you hand over the cash without asking for anything in return, right? Wrong. You're actually doing what's called an interest-free loan. Now imagine the next day your friend comes back with $105. They didn't have to pay you back the full $100. Instead, they gave you $105, which includes an extra $5 for borrowing the money. That extra $5 is the interest. Now imagine if you had loaned $100,000 instead of $100. That would be a pretty sweet $5,000 return. That's why when you borrow money, whether it's a mortgage, a credit card loan, or even a line of credit, you're essentially paying a fee to use someone else's money. But there's more to the story. Central banks, like the Federal Reserve, set what's called the base interest rate. It's like the starting point for all other interest rates in the economy. Think of it as the conductor of an orchestra, guiding the overall tempo. When the Fed raises rates, it's like turning up the volume, making borrowing more expensive. When they lower rates, it's like turning down the volume, making borrowing cheaper. All the other rates follow the Fed's lead, influencing everything from mortgages and credit cards to business loans and savings accounts. Okay, so we got the basics of interest rates. Now let's talk about how they can shape our economy. During the Great Recession of 2007 to 2008, interest rates played a pivotal role in the housing bubble burst. Before the bubble burst, lenders offered low-interest mortgages, fueling a frenzy of home buying. People were taking out huge mortgages because they seemed affordable. But then the bubble burst. Foreclosures and bankruptcies skyrocketed, and the entire economy took a nosedive. Here's another example. During the COVID-19 pandemic in 2020, central banks slashed interest rates to near zero to stimulate borrowing and spending. This helped cushion the economic blow, but it also led to a surge in inflation. We've seen this pattern play out again and again throughout history. Let's fast forward to the 1970s. The US was hit with a severe inflation crisis. Prices were soaring, the economy was unstable, and people were losing faith in the currency. Enter Paul Volcker, the chairman of the Federal Reserve, who took drastic action to tame inflation. He raised interest rates to a whopping 20%, essentially putting the brakes on the economy. At first, it was painful. Unemployment rose and economic growth stalled. But Volcker stayed the course, and in the long run, his high interest rate strategy paid off. Inflation was brought under control, and the US entered a period of sustained economic growth. But here's the thing. While interest rates can stabilize economies, they're not a magic bullet. Countries like Japan have struggled with low interest rates for decades without much success. And in countries like Brazil, high inflation has persisted despite high interest rates. The lesson here, interest rates alone can't solve every economic problem. And this is where things get interesting. Setting interest rates isn't just a technical task for central banks. It's a strategic game that can benefit some while leaving others behind. Let me explain. Low interest rates encourage borrowing and spending. This can be great for individuals or businesses looking to invest and grow, but it can also stoke inflation, potentially eroding the value of your savings. High interest rates, on the other hand, can curb inflation, but they can also slow down the economy and increase unemployment. It's a balancing act, and central banks constantly walk this tightrope to keep the economy stable. But here's the twist. Who exactly benefits from this game? The answer might surprise you. Take the wealthy, for instance. They often have substantial assets and connections that allow them to take advantage of low interest rates. They can borrow large sums at low rates to invest in property or businesses, potentially increasing their wealth further. Then, there are big institutions like hedge funds and investment banks. They have the expertise and resources to navigate complex financial markets, allowing them to capitalize on low interest rate environments. But the everyday person, well, they might not fare as well. Low interest rates can erode the value of their savings, while high interest rates can make borrowing unaffordable. It's like playing a game of chess, and these pieces are moving on the board. The wealthy and powerful have the resources to anticipate the moves and position themselves strategically, but the rest of us, we're left trying to figure out the best move. But remember, this game isn't set in stone. You have the power to educate yourself, adapt, and even thrive in any economic environment. Knowledge is your secret weapon in this game. Understanding how interest rates work and how they impact your life is the first step towards taking control of your financial future. Whether it's tracking interest rate changes, building emergency savings, or avoiding predatory lending, your actions today can pay off big time tomorrow. Okay, so how can you outsmart the system? First, track interest rate changes. Just like a chess player studies the board, you need to monitor interest rate changes. When rates go up, shift your focus to saving rather than borrowing. Look for ways to cut expenses and build your emergency fund. On the other hand, when rates drop, explore opportunities to invest your savings or refinance your debts. It's all about being prepared. Second, build emergency savings. Having an emergency fund is crucial. It acts as a buffer between you and unexpected financial shocks, like a sudden job loss or medical bill. With an emergency fund in place, you won't have to rely on high-interest credit cards or loans during tough times. Aim to save at least 3 to 6 months' worth of living expenses and keep this money in a separate, easily accessible account. Third, avoid variable rate loans. These loans come with interest rates that can fluctuate, leaving you vulnerable to sudden rate hikes. Instead, opt for fixed-rate loans. While you may not get the most competitive rate, you'll have the peace of mind that comes with predictable monthly payments. Fourth, learn how to move when the system shifts. Be adaptable. When the economy changes, don't panic. Assess your financial situation, explore alternative income sources, and be willing to adjust your lifestyle if needed. Finally, keep educating yourself. The more you understand about personal finance, the better equipped you'll be to make smart decisions. Read books, attend workshops or online courses. Stay informed about changes in interest rates and how they affect you. Knowledge is your greatest asset in this game. Remember, the game of economics isn't rigged against you. It's just complex and ever-changing. By understanding the rules and staying informed, you can position yourself for success. Keep learning, stay adaptable, and never stop fighting for your financial well-being. In the end, interest rates might be invisible, but their power is real. They influence our economy, our careers, and our everyday lives, but by understanding how they work and how they affect us, we can harness their power to our advantage. So don't be a pawn in someone else's game. Be the one calling the shots. Take control of your finances and shape your future. If you want more content that reveals the truth behind money, finance, and freedom, subscribe now. Your future self will thank you. And remember, knowledge is power. Use it wisely and never stop fighting for your financial freedom.